The world's second-largest economy isn't doing as well as it wants to believe it is, and the tremors might be felt from Shanghai to Washington. China's economic engine was once considered unstoppable. However, now it's grinding in slow gear. Beijing's GDP growth for the second quarter of 2025 has dipped to 5.2%. Though this is above market estimates, it has slowed down from a 5.4% growth in the first quarter of 2025. Their government says that in quarterly terms, the world's second-largest economy expanded by 1.1%. Gross domestic product, GDP, grew by 5.4% year-on-year in the first quarter and grew by 5.2% year-on-year in the second quarter. On a quarter-on-quarter basis, GDP grew by 1.1% in the second quarter. The external environment is still complex and volatile, and internal structural contradictions have yet to be eased at all. The foundation of the economy still needs to be strengthened. Overall, we believe that there is backbone for China's economy to maintain stable growth in the second half of the year. Consumption is now the main driver of economic growth. However, some analysts said actual growth may have been significantly slower. Experts at Capital Economics noted that investments in fixed assets such as factory equipment rose only 2.8% in the first half of the year, implying 2.9% annual growth in May and a mere 0.5% increase in June. The 5.2% growth rate overstates the pace of expansion by about 1.5% points. Capital Economics Activity Proxy shows growth in China's gross domestic product, or GDP, at less than 4% year-on-year in April and May, which forecasts annual growth of 3.5% for full year 2025. Also, a key factor behind the latest upbeat data was strong exports. This week, China reported that its exports accelerated in June, rising 5.8% from a year earlier. Production of high-tech products, vehicles and electrical machinery and equipment rose by about 10% or more from a year earlier. A reprieve on painfully high tariffs on Chinese exports to the United States prompted a rush of orders by companies and consumers as the two sides resumed trade talks. Chinese companies also have expanded exports to and offshore manufacturing in other countries such as Vietnam, helping to offset the impact of higher tariffs imposed by the Trump administration. However, a 0.1% decline in consumer prices in the first half of 2025 showed continuing weakness in domestic demand. This remains a long-term challenge for the ruling Communist Party as the Chinese population declines and ages. You see, Chinese consumers are spending less, businesses are slashing forecasts, and foreign investors? Well, they are watching nervously from the sidelines. While retail sales are cooling and industrial production is stalling. But Beijing's youth unemployment is reportedly soaring. And what's making the situation worse is U.S. escalating trade war, because it could end up eroding China's only cushion, which is exports. Though there was a temporary reprieve, there are just weeks to go before President Donald Trump's 30% global tariff blitz is set to take effect from August 1st, that threatens to wall off American markets from dozens of export-heavy economies, including China. And remember, in April 2025, Trump already cranked up tariffs on Chinese goods to a crippling 145%. Chinese leaders had set a growth target of 5% for this year, in line with last year's growth. A resumption of U.S. tariffs of up to 245% if Washington and Beijing fail to meet the deadline for a new trade deal could derail the recovery in exports, a major driver of growth and employment. And global markets are watching every word from Washington with a magnifying glass. Beijing, for now, is trying to mask the damage. But the real story lies in the numbers and in the silence from China's central bank, which has avoided any aggressive stimulus measures despite the slowdown. For more updates on this economic showdown, keep watching Mint.